This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
Back, everybody. Another episode of Real Estate Investing 365. Today, we got Nichole Stohler here. She is she currently lives in Scottsdale, Arizona, and she has a podcast and a real estate business. She got into the hotel business, all kinds of different things. So I'm excited to dive into that. Nichole, thanks for being here.
Justin, thanks so much for having me on.
Yeah, absolutely. So before we get started digging into exactly what you guys do now, I want to get your backstory and kind of how you got into the real estate investing and different businesses that you're in, because you have a story. Like a lot of people have the dream to get away from their W-2, but it's hard to do that for some people, and you made it happen in a big way. So can you kind of dive into that and tell us your backstory?
Backstory starts with failure, which I always like to share because I think it's important for people to hear the bad that also happens, right? Because if you only hear success stories, then it makes you feel like, what am I doing wrong? And I should have that kind of success. And behind every success, there's usually a bunch of failures. And whether the person owns up to it or not, likely there were failures. So I can absolutely share transparently.
Yeah.
Our story actually starts in 1999. We read Rich Dad, Poor Dad. My husband and I were both working, fresh out of college, and we didn't have a lot of money at all. I was actually working a second job because my first job out of college didn't pay that well. And we basically I was kind of obsessed with personal finance books, and that's how I ran across Rich Dad, Poor Dad. Kind of opened my eyes to this whole concept of having your money work for you, which nobody had ever taught us that. We did not learn that in college. We did not learn that from our parents. Everybody that we knew and we were surrounded around basically went to go work for a company for 20, 30, 40 plus years, worked really hard, lots of strong work ethic, but just no real concept of buying or owning a business. And in that book, particularly Robert Kiyosaki, he talks about owning a business, which could be real estate, but it could be any other type of business. It's just that real estate was personally appealing to us. We signed up immediately for a seminar and came back from this seminar, which was all about how to creatively buy real estate with no money. And the reality is you do need some money, but you can do it with no money or a little money. And that's what we did. However, all the things we did not know that we were not taught at the seminar, which would be, do you actually want to buy this particular property? Just because you can doesn't mean you should. Do you know how to manage residents? No, we had no idea. They walked all over us. How do you manage, the property itself? What can you do? How do you add value? All of these things that are really about running a business, we were not taught. We were just taught how to go and acquire. So we absolutely failed, gave back those properties, sunk deeper into debt. So that's kind of the little backstory of failure.
All right. Yeah, that's a good story. So I want to unpack it obviously a little bit. First, was your husband kind of on the same page as far as like the personal finance and all that sort of thing that's led you to finding Rich Dad Poor Dad, or was it like he didn't have any idea of this and was it a struggle to get him on board with the investing side?
Not so much, but this is interesting. Years later, we've recently taken what's called the Kolbe, Kolbe assessment, which tells us about how we get things done. And I'm really high on the quick start. So like I'm the person who is kind of out there looking for ideas, researching, and goes after things. And he's much more of the like kind of the details and getting into the minutia once something is started. So he's usually pretty supportive of my crazy ideas or the things that I'm approaching because we just have a really complementary, we're not opposing in the way that we get things done.
Okay, cool. Well, yeah, I just asked that because, sometimes people, especially just out of college, you're like excited to get your careers going and you're working hard. It's like hard to take your mind off of that and like focus on like now another aspect, like, hey, I want to get out of this and like go, which is, I haven't, I've had a little bit of that problem, but I'm kind of like you to where I'm just like, all right, let's do it. Go right now. And then my wife's like, okay. And then once we get in it, then she's like really key and like, okay, she's all in, she's like focused on it, but it's me just like the shiny object. And then she kind of keeps me like narrowed, you know what I mean? Like on path. So, all right, cool. So that was in 1999. You read the book. What year did you end up buying your first 3 properties?
Those properties, so we came back, that would have been the end of 1999 on into 2000 was really the time frame. So we were very fast. One of the things that they taught us in the seminar was to connect with universities that may have been given property when someone died and left in their will to the university. And we lived in a small town, but there was a small university there. So all this was actually pretty easy. A lot of people knew each other. My husband knew real estate agents, reached out to them, asked if there were any properties. And then the university at that point in time had zero interest in actually owning the properties themselves. So they were willing to be creative, and we got them with seller financing. But we did have to have some kind of down payment, which this was 1999. So we used credit card cash advances for those initial down payments. But basically, it probably took about 6 months for us to realize that this was not, we were not on the right path. I would say reality, they were not good properties. We just didn't know how to evaluate the properties. We were just so excited that we got properties with seller financing. It seemed glamorous. It's not glamorous. It is not glamorous if you have not chosen well. We did not choose well. They were not in good areas. It's not easy to keep them rented. Many challenges and deferred maintenance. So by the end of 2000, we had given them back, and my husband went to go work in property management.
Okay. Well, I want to dive into these properties a little bit more because people are probably like, well, what were they? They're so horrible. So where were they? You found them through the university, but did you just call the university out and say, hey, by the way, I want to buy a property? Or how did that work? And then why were they so horrible?
Okay, so let's start with finding them was connecting with different real estate agents. And there was an agent that was representing the university that had those properties for sale. So it's kind of like when you hear people say, hey, build your network, build your team. So we were reaching out to agents and we were saying, hey, we're interested in, long-term rental properties. Do you have anything available? Do you know of seller financing? So there was kind of some of the tips from the seminar, which was this whole seller financing approach. And that is how the agent that was representing the university, that's how we got connected. The properties were, there was a 4-plex, there was a 3-plex, and there was a single family home. The 4-plex was completely vacant. Definitely a C proper, maybe a D, more like a D property, not a good area of town at all. The 3-plex, slightly better area, maybe like a C minus. 2 of the units were rented already. And then the single family home was not too bad. That was a HUD property. So that would be Section 8, and then there are some government rules around it. So that also starts to limit some of the things. If you just didn't know anything about owning that kind of property, it limits some things going into it as well.
Okay, so where was this? I don't think you mentioned the city.
Oh, Anderson, Indiana.
Anderson, Indiana. So I'm not familiar with Anderson, but it's kind of a smaller, kind of rural-ish town, or is it a city town?
At that point in time, there were probably 60,000 people in the town. There is a university, it's Anderson University, and the town itself is about 40 minutes outside of Indianapolis.
Okay. Is it by Terre Haute?
It's on the other side. So Terre Haute's on the west side, and this was on the east side of Indianapolis.
Okay. I went out there recently, and I went to Indianapolis and Terre Haute, and I was like, this is kind of interesting. It's still cheap there in Terre Haute, especially. It's a cheap area. Find those good properties, I guess. So I guess this process that you found these properties by really was a good way. And the problem lied in the fact that you guys didn't really, at the time, educate yourself on like what to look for, look at the area, what the tenants are going to be like. All you knew was like you found a great way to find the properties, but they ended up not being great properties. So really, the process was good. It was just the execution was not there.
It was, and we didn't know what we didn't know, and we had not been taught that in the seminar. And then this time, if you think about it, 1999, there's not Bigger Pockets. There are real estate clubs because those have been around for a while, but ours was in Indianapolis. We were in Anderson. We weren't part of any club. We didn't have a network of people. There's no one we could reach out to who'd say, hey, well, here's what you should do. Like there was literally no guidance
Yeah.
beyond how to buy the property in the seminar. So check the box because that seminar did what it said, but there were all these other missing pieces.
Right, for sure. So yeah, the good takeaway from that is that, if you go to a seminar and they're teaching you how to find the properties, that's great. But especially today with so much information out there, podcasts, all the books, Bigger Pockets, especially, just make sure you do your due diligence on like what to look for in the properties, the area, the city that's in, the type of tenant class, all that property management, if you're going to do that. So, that's definitely important, and they probably would have been better if you would have done that, but that's okay because it was a lesson. So then your husband moved on into you gave the properties back. He moved on into the property management field. What happened next?
Okay, yes. So we said, hey, we're committed to this, but we just realized how are we going to learn about it? And again, not having mentors or the community, we said, okay, he's going to have to go work in property management, which he was excited to do so. I mean, he was very interested. He wanted to learn and understand it. And so he did go do that, moved up within the company. That company was very different. When you say property management, I think there's many different slices of the industry. In this case, that company was a build and manage. So they built their own apartment complexes and then managed their own apartment complexes. So it was like the smallest was probably 400 units up to like 800 unit apartment complexes. It was not a property management company that was managing other investors. It was not managing single family homes. So from the get-go, the education and the experience he got was in multifamily because that's where he went to go work.
Yeah, no, that's excellent. That's probably even a better place to go work for because you get to see, I mean, I'm sure if they would let him see the whole process, right, of like building the properties and all the numbers and or whatever he was able to see, that's a kind of a good place as opposed to a company that just takes over a property. You don't really get to see the behind the scenes and why it makes sense or whatever. So that's cool. That's interesting. So then when did you guys end up buying your next set of properties, and did you stick with single family or did you move into multifamily since your husband was now part of that field?
Yeah, so we had a few just single family, but really didn't do much again
Mm-hmm.
for a variety of reasons. A little bit of a career change, moved out to Arizona, lots of things going on in the meantime. And we started buying again in 2011. So we took a significant break. Part of what we were doing during that time was we were building up capital. We wanted to be in larger properties. Originally, our intention was to buy like a 100 unit complex in Indiana. And I say that because like the property prices in Indiana, 100 unit complex was pretty feasible as we build up our capital to be able to invest.
Mm-hmm.
Then we moved out to Arizona, not feasible to buy 100 units in Arizona, just, more expensive properties, different type of environment. And so we needed more capital. So in Arizona, what we did is we started with a fourplex and a sevenplex right around about the same time.
Okay.
And it was cool because the sevenplex was actually two parcels. So we were able, so it was like 4 and 3, and then we had 4. And so each of those was an awesome 30-year fixed type of mortgage that you can get. That's such a sweet deal, right? Because
Yeah.
the mortgage rates were low, all of those things. But we ended up actually selling those, rolling them through a 1031 exchange into a 28 unit. And then selling the 28 unit, rolling that into a 50 unit, then selling that, rolling that into a hotel, and then buying our second hotel with some of our own capital and then also investor capital.
Okay, that's awesome. So a lot of people now, especially today, are really interested in the multifamily space. That's like what everybody wants to do, right? Everybody wants to get into like the small to mid-sized apartment buildings. So, what were some of the challenges around getting into that field? As far as talking to brokers, getting them to take you seriously, finding the properties, doing the numbers. How did it kind of all work out to move from the 7 and the 4 up to the 28? Because that's kind of a big jump. You don't just, it's not a insignificant jump.
No, it's not. And each time we make a jump into like the next bigger and bigger, it's sort of like you're stretching, right? And you're reaching those next level goals. And there's always a part of you that says, oh my gosh, this is bigger and more complicated. But you take the basis of what you've learned and then you grow on top of that. So going into the 28 unit, we were already working with a broker that originally helped us with the 4 and the 7.
Mm-hmm.
And that particular broker was very much of a bulldog and just, kind of pushed to be able to get us into the 28 unit. But we already had a track record with those smaller properties. So I think that you can work with a broker, start with a duplex, a triplex, a fourplex, prove, sell it, continue to build that relationship with the broker. So they get the commission, they sold it to you, they get the commission when you sell it, they have seen and they can vouch for you. And if they're a broker who has a long track record and experience in the market, that certainly goes a long way toward their ability to vouch for you that you're going to get the deal done, that you're absolutely going to close, etc.
Okay, cool. So you found that, so he brings you the 28 unit property. Did you guys know how to do your due diligence and like run all your numbers on the 28 unit beforehand, or did you kind of learn as you went?
So we did. That particular broker also provided a lot of education for us around the discounted cash flow, which is a spreadsheet that you would leverage in the commercial space. And our broker also had what's called the CCIM designation, and that is really the top level of a commercial broker that has really gone through classes and understands and can really guide you. So it's so different, right? If you're working with, when you bought your house, that realtor is about emotion. They're about, oh, what do you want from your house? Can you see yourself living here? This is great for your kids, et cetera, et cetera. It's emotion. When you're buying a commercial property and you're working with a broker that understands this is an investment, they're guiding you through the process, and they'll put together what's called a pro forma. Mike, my husband, is not big on pro formas,
Yeah.
because he's a very detailed guy, and he's like, yeah, that's the pie in the sky. That's like
Yeah.
everything's perfect.
Which is good. That's how it should be.
Yeah.
Yeah.
And so he'll tweak that quite a bit. He'll get into the spreadsheet. And basically we had the broker, kind of walk us through that. And then Mike was able to contribute based on his own experience in property management, knowing what really happens, and then tweaking it from there. But I just want to say that there's always surprises. There's always a surprise. And if you plan for that, like, it does not matter how amazing the property is, there's going to be a surprise that you didn't plan for. So now you know to plan for what's going to be a gotcha.
Yeah, definitely. How did you end up financing that property?
So the 28 unit, actually, we got into seller financing, and then we flipped it because I wanted to very quickly get it into a more long-term commercial loan. We flipped it into a commercial loan, which that is when you were talking about how did you get people to take you seriously. When you go for a commercial loan on a 28 unit, now you are talking about your resume. What kind of experience do you have? At least in our case, they really wanted to see that Mike had that property management background. So I think that some folks that are mentoring people, they'll talk about building your brag book or building your kind of resume that you take to a loan officer.
Mm-hmm.
That's really key. And it also worked, and it's really important in hotels too. So when you're in these bigger commercial spaces getting large loans, they want to know that you have a track record or what your experience is.
Yeah, for sure. Okay, that's good information. What went wrong in the property that you kind of like you had alluded to? There's always something that's going to be an issue that you're going to take note of and bring that knowledge to the future. So, what went wrong in this 28 unit that you knew to address in the 50?
The 28 unit, some properties have a culture, and I don't, I can't put my finger on it as to how you can effectively change the culture unless you turn over the entire property.
Mm-hmm.
So let's just talk about like a single family home that is an isolated resident. You create the culture. You set your policies and procedures. They don't talk to any of your other residents. They don't know what's going on.
Yeah.
They are living in that house. When you have a multifamily property, people talk. There are rumors. It's a small community, and so there's a culture there that a couple of bad apples or just not the best residents
Yeah.
can turn the property culture a certain way. And it's very interesting, and we've had both sides of that. The 7 unit that I mentioned, where it was like a 4 and a 3, that had this amazing culture. People had lived there 20 plus years. They looked out for each other. There was a wait list. In fact, we never had to advertise. They knew who they wanted to live there next, and they had, friends and relatives, and it was just almost like a self-managing property.
That's awesome.
It is. And when you
Yeah.
can find that, if we were to look back, we probably shouldn't have sold it, but we needed it for the 1031, et cetera. But
Yeah.
the 28 unit, it was just a tough culture. So what does that mean? It means turnover. It means fights. It means, just a lot of things that you're dealing with. And of course, the other thing to that's kind of interesting to think about is for the cost of getting into these properties. These are not A-class apartment complexes.
Right.
Those are multi-million dollar top development. Like those are the properties Mike was managing for that company.
Right.
But you have to build up to that, or you've got so much private equity coming in. So you're talking more of a C and a D class apartment complex. So you are dealing with a different kind of resident as well.
Yeah, for sure. So, how can somebody know what that culture is going to be before they really get in there and start managing the property? Like, what is it? Some things they can look for that's like red flags.
Yeah, I think so you always ask for a rent roll, right? And so you can see how long have people been there.
Mm-hmm.
And just as a side note here, almost every single property on the market is going to say 100% occupied. And
Yeah.
Mike always says, well, of course it is, because they went out and they found that, like, they didn't care. They suddenly set their standards really low and said, let's get this apartment rented so it can be 100% occupied so we can sell it for a higher amount. But the reality is you want to look at the rent roll and you want to understand how long the residents lived there. And then I think if it's possible, you want to try and talk with some of the long-term residents and get a sense of their experience. And one, could you do better on property management than the current owner is doing? But two, what's the culture that comes out when you're talking with a couple of those longer term residents?
And I'm sure you can kind of tell by walking the property, if there's like, the doors are all scratched up and beat up and there's trash laying out like right in front where it's easy to pick up, or little things like that. I'm sure kind of like give not red flags, but just like an awareness of what the property is going to probably be like to work with the tenants. A good book, what is it? Crushing It in Apartments and Commercial Real Estate, Dave Lundahl or Brian Murray. I think he talks about this exactly the same thing in that book, to where I think he bought a property and had the same thing where the tenants were like coming against him almost, and it was just a whole environment. So that's interesting to know, but I'm sure you guys figured it out, because did you guys self-manage or did you hire a property management company?
We self-managed.
Okay.
There was a short time on the fourplex, that very beginning fourplex, where we hired property management. And that was eye-opening for us as a side note here, because if you think about Mike's experience, he was working for a company that managed their own properties. So when he thought about property management, his lens was that they had the same kind of interest. But the reality is not the case. You have to work really hard to find a good property manager who cares about the property, because it's really your asset. And there's a lot of bad property management companies out there. But there's ways, and you can interview and you can ask the right questions. But in our case, that was a little bit of eye-opening for us too. And again, it's just we didn't know, because he had been in property management where, again, it was ownership as well. So it's just very different. And from that point on, we always self-manage.
Okay, cool. So you went from the 28 to the 50. Now buying this 28 and 50 unit properties, this was like in, I assume, like 2013, 2014, that time frame.
Yes. Yep.
Now, since everybody's probably wondering, a lot of people that are new investors too, they're like, about the economy. Is it still possible to find those types of deals like now? Probably not around Scottsdale or Phoenix area.
No,
No.
it is not. And that's why we're in hotels. So that's a little bit of why we made that transition.
Yeah.
There are still a ton of people coming into the Phoenix metro area. There's new build going on. We have a lack of supply, and so it is a good space to be in. But the cap rates, the returns, what you can get, most apartment complexes have already had their repositioning, right? They've already had value add. The investor has already come in sometimes twice, and that's happened. So there's been a lot of turnover of properties to the point where there's not much room left. So I would caution anyone, at least in our market, to getting into multifamily, because your incremental value, like all you can really count on at this point is incremental rent increases. And our rent increases have gone up every single year, but there might be a point in time you can't count on that. So if that is your entire exit strategy or your growth strategy, you've just not been able to give yourself as much room as you could back when you could add a stackable washer dryer, add covered parking, add some of those things to bring up the value and increase the rents.
Yeah, so I asked this to the last person I interviewed. Do you think it's a new normal for, right? What I'm getting at is where early 2000s, before the crash, the cap rates were gradually compressing and getting down to probably 5%, especially in certain markets, Phoenix, maybe even lower. And then all of a sudden, right, the crash happened and cap rates went up, right, because the economy, the recession and all that stuff. So cap rates are up high, and now they've kind of started to drop back down to where it's almost in line with where it was before. Like, it's, if you take the recession out, it's in one line. If a cap rate in the last 5 years or 6 years was going for 8%, now it's down to 5%. Do you think the 5% is now the new normal to judge off of, to where we just have to dealing with lower cap rates and lower returns? Or do you think something's going to happen to where it's going to come back and people are over leveraged?
I think that I have no idea.
Yeah, obviously.
Except for what we saw that happen, which is why we didn't continue in multifamily, because we benefited from that, right?
Mhm.
Our 28, our 50, we benefited from that cycle, and we were buying at the right time in that cycle. We don't feel like now is the right time, so we're not buying in the multifamily space. Well, partially, and I do want to clarify, it's because, and again, our lens is the Arizona market. There's a lot of reasons why we want to be here, but when it comes to multifamily, we don't feel like this is the time to buy, because if you look at all the factors that could change, you're buying a property right now with still historically really low commercial loan rates, but those rates could reset. But we don't know what they could be, right? And they will reset at least in 5, 7, or 10 years, depending on which loan you got. So now they're resetting. Do you have enough rent? Can you still make income with that? Have you done stress tests? Have you done that, kind of conservative analysis? And are you paying too much for the property that your rent has to be up here and there's no room to drop it? Well, more supply comes online, and suddenly those Class A apartments, which are generally all the new ones, they're offering all these specials, and then that's squeezing the B class, and then so you could see a scenario like, okay, instead of being 100% occupied, you're 60% occupied. And now you can't pay. Oh, and by the way, it's your 5-year, it's resetting, it's going to be higher. And oh, now actually, maybe you can't even get financing because your rents don't sustain the payment and it's not valued because, that's part of the commercial loan process as well. So I think we were scared by seeing the benefit that we got from that enough to say, okay, we're not going to be in multifamily right now.
Yeah. Okay. That's good insight. I think people have lucked out recently that rates have stayed so low. So oftentimes, properties that were bought in 2013, 14, 15, and they're resetting right now. A lot of times they're getting lower interest rates, but I don't know if the interest rate's going to stay low for we don't know all that stuff. You know what I mean? So they might luck out and it might stay low and they might reset to a lower interest rate. But if as soon as that ticks up a little bit, I mean, people are going to be hurting or underwater, I would assume. So at what point in this process did you guys leave your full-time job? Does your husband still work full-time? Do you work full-time? How does your careers look as far as that?
I work full-time. I'm in tech.
Okay.
And I think there's a lot of benefit and value that I get from being in tech. I love it. So I think when people talk about, leaving their careers, if you love what you do, that maybe you're not feeling that same way. I work for an amazing company, and it's really in my blood. So I think that is an interesting topic because I think a lot of people assume everyone wants to quit their job.
Mm-hmm.
But what I advocate for is, and I do believe, and part of my podcast is about helping people understand that you really can't get ahead if you don't own or invest in a business. So that could be real estate, it could be other things. You can't just put money into your 401k and expect that you're going to be able to retire and live the lifestyle you want. And if you're in tech, there's more that you should be doing. So that's kind of the premise of my podcast, is to encourage people to do that. My husband, full-time, manages our portfolio and our team of people that are doing the day-to-day operations.
Okay, cool. No, that makes sense. Yeah, I fully agree. If you like what you do, I feel like it's like I don't know what the word is, like a hip thing or whatever, to say, oh, I'm going to leave my job and do real estate full time. Well, that's great if you really want to do that more than the job you're doing. But I would rather, I want to find a career. I'm leaving my job soon, but I don't like it. I don't like climbing power poles all night long. But I want to find something that I'm doing that I never have to retire. Like, I'd rather never retire, honestly. I'd rather just work on something that I feel passionate about and that I feel like get enjoyment by and fulfilled by is the more important thing. So I think that's a good way to put it. If you don't hate your job, well, it's a good place to be, it's like a good background for sure. So you guys move into the hotel business. Now, a lot of people, this is like a strange thing. A lot of people don't think about, oh, I'm going to go into the hotel business. How did that kind of work out? And let's go over your portfolio on that now.
Sure. So that is a great example of the power of networking and building your network, especially local, because real estate is local. We had been introduced to a hotel guy by our broker. And what the broker said is, hey, I'm working with this guy. He's buying land. He wants to build a new hotel. That's all he does is hotels. And I think it would be a good connection for you. So, okay, we went and grabbed coffee and we immediately hit it off with him. We liked him right away. He's very conservative like us, very grounded in the fundamentals. And the other thing was the numbers that he was talking about. I mean, we had never looked at or explored hotels, so we were extremely intrigued by the numbers. And we decided, okay, you know what? I think we want to do this in addition to, we already had, the 50 unit. We want to do this in addition to. And there's a little interesting story here, which is I called up my CPA and I said, look, I'm going to take some funds out of the market so we can invest in this hotel. And my CPA freaked out, called me into the office. You can't do this. You're going to pay so much in taxes, et cetera, et cetera. Fast forward to, I have a podcast where I interview people and we talk about funding mechanisms and all that. And I have since discovered that there is a way that I could have done that and avoided the taxes and leveraged my money to invest and even draw a salary against it, which is a whole program and a whole process. But I did not know any of that. And so again, it's an example of, not knowing and not having people that mentor and guide you. So as a side note there, just investigate all options. Is not your CPA maybe doesn't have all of the scenarios or know all the possible ways that you could do something you might want to do like that.
How can we find a CPA that does know all that?
I don't think any CPA would. I do think that you would need to investigate, like listen to the podcast, right? You'll hear people talk about self-directed IRAs. You'll hear people talk about solo 401ks. The program I'm talking about is called the Rob's 401k, which I only found out about because of interviewing a franchise broker. So it's interesting. I feel like there's just more and more resources that are being put out, and this is something someone taught me recently. Your CPA is there to do your taxes and to follow the law around taxes. Mm-hmm. That is it. That your CPA is not necessarily your tax strategist, not necessarily the person that helps you come up with how you could do something like that. So you probably need to find someone else who could be your strategist financially, because that's not what your CPA is there to do.
Sure. Okay. No, that's good. Good points, good topics. Okay, so what happened? You decide, hey, I'm going to pull this money out. We're going to invest in the hotel. Walk us through that.
Yeah, so didn't pull the money out because I didn't know any better, and I believed my CPA, and what they were talking about was true and valid. It's just they didn't know about other mechanisms. So didn't pull the money out, didn't invest, just continued the dialogue, had the conversation. Fast forward to, we got an unsolicited offer to buy our 50 unit. This is really when the market started to heat up around multifamily. And we turned it down 3 times, but that particular person was under 1031. And so they were really anxious to purchase a property. Yeah. And that 50 unit was it was a very good property. Hindsight, it, again, it helped get us into hotels, but probably a property that like a good one to hold on to, good culture, some of those things I talked about. Mm-hmm. In any case, so we were going to be under 1031. And we were going to have the time pressure, and we would have to figure out what we were going to buy. And at that point in time, that multifamily market had heated up and the cap rates were compressed, and we just didn't see numbers that to us were worth our while. Mm-hmm. And we called up the hotel guy and we said, hey, do you know of any off-market hotels? Because maybe that's what we could be doing now with our 1031. And he does. So, being part of a industry, knowing a specific, if you know multifamily or self-storage or hotels, you build up a network of people. So he was aware of an off-market opportunity, and we ended up partnering with him. So the way that we partnered, it's our hotel, we bought the hotel, it's our loan, but he runs operations, and he introduced us to the right commercial brokers, and he had the resume with the background and the experience. So one thing I would encourage is, if you're looking to get into a larger type of property and you don't have the experience, find someone who does and give them a portion of the proceeds, the revenue, the sellout, whatever it is that makes sense, that they're invested in your success, and they bring that background that you don't have, because that's the way I do it now if I was just starting all over in multifamily or self-storage or anything else like that.
Yeah, for sure. Okay, so was this a branded hotel or was it a boutique hotel? What kind of hotel was it?
Yeah, so we are in branded hotels. Boutique hotels absolutely make sense if you are, in tourist areas, which we are, but you're going to pay a lot more, right, for a boutique hotel. So unless you're talking massive, very large, like a JW Marriott resort,
Yeah.
obviously that's a lot of money there for that kind of property. But yes, these are branded hotels. So that's an interesting dynamic because now essentially they are franchised hotels. But we are buying the hotel based on the fundamentals. We're buying it based on the location, economic drivers, value add opportunity, ways to increase revenue, potentially decrease expenses, but we're always really more focused on the sales and the growth opportunities, and what the brand is kind of secondary, unless it's like a terrible brand, but it's kind of secondary
Uh,
to those basic real estate fundamentals.
okay, so what are some value add opportunities that people could look for in a hotel?
Yeah, so the one that we recently purchased, one of the value add opportunities is the completion of what's called a PIP. And some hotel brands, they'll go through phases where they refresh what they want the hotel to look like. They have new standards for, furniture and carpet and paint and bedding and all of those pieces. And that is called a PIP. It's a performance improvement plan, which sounds like a bad thing. If you're a W-2 employee, you're thinking, that's not a good thing. But it's actually the opportunity to refresh your hotel to the set of standards set by the brand. So this particular hotel had a partial PIP completed, but a remaining all of the rooms needing to be renovated, etc. So there's an opportunity to increase revenue as a result of a refresh, almost like a brand new hotel, because of really everything in the hotel being replaced with the upgrades.
Okay, so does the franchise obviously runs that, like says like they give you a time frame, this is when it needs to be done, and these are all the materials you guys are going to use, and you buy it through the the franchise corporate headquarters, or how does that work?
I think maybe all franchises are different, but in this particular case, there is a set of standards because if you think about it, the whole piece around branding is when someone goes and stays in a hotel under a specific brand, they want to know what to expect.
Hmm.
So they want it should have the same look and feel and be up to standards. But the sourcing of the materials, we have more flexibility, at least with this particular brand. So one of the things that we really emphasize with our hotel ownership is that we're locally owned and operated, and we work with local companies. So we are working with a local office furniture type of company
Hmm.
that's supplying the furniture for our particular hotel, as opposed to working with some outside of Arizona company. So we try to keep things as local as possible, and source our materials and things like that locally.
Okay, cool. No, that's good information. So how did the financing look on, because I know the first deal you guys bought yourself and the second deal you guys ended up doing the syndication model. But on the first deal, how did the financing look? Is it the same type of financing that somebody would get on like an apartment building?
You you have a benefit in hotels in that you can do a small business loan,
Hmm.
and that gives you very favorable rates and terms. It does require more paperwork,
Uh-huh.
and it is pretty involved from that standpoint. To the point of, it is government backed, and so there's a slower process as a result. So catch 22, but we have small business loans on these hotels, And so favorable loans and rates and terms as a result of that. And then the first hotel, essentially, we brought all of the down payment and then small business loan. The second hotel, we invested some ourselves and then investors for that down payment. And then we have the small business loan.
So the small business loan will cover the real property as well as like buying the business and the franchise fees, because I assume there's franchise fees to go along with it.
Yeah, and the PIP, so some of that funding as well. Now there are nuances to small business loans. You can only have so many. Like you will get maxed out at a certain point. There's a couple of different types, so you have to have maybe one of each type. So it's not like you can get a small business loan over and over again for 10 hotels.
Yeah.
But you can absolutely do it for a couple like we have, and then grow from there into more of your traditional commercial financing. Not quite as favorable, but still an option.
And I'm sure there's plenty, just like with real estate, once you get to a certain loan amount, you can always go to local banks. I'm sure there's local banks out there that'll do, they'll do hotel loans just like they'll do an apartment loan. I'm sure, you just have to go through and call them and talk to a lot of people and find the right ones. So,
yeah. Well, I'd say, first of all, the niche for loans in hotels it's a smaller pool of banks that you'd be working with than you would in multifamily.
Yeah, for sure. Definitely. Okay. So their most recent hotel, you guys ended up syndicating that. How did that process work? Did you guys have like a mentor that you talked to, or did you kind of just like go in and say, oh, I'm going to figure this out, and you made it happen?
We did not have a real estate mentor as it related to syndication, but we had a couple of other types of mentors. And I say this because we invested in a med tech company that those folks that we are friends with, they had done, raising capital, and they had experience with that process. We also are good friends with someone that has been doing syndications for restaurants. So both of those folks helped us with kind of the overall structure that applies to anything that you would be doing. And then we worked with a very specific team of lawyers that do hotel actually and real estate syndications here in the Arizona market. I mean, not that everybody's in Arizona, but a lot of their clients have base here. And then basically they helped guide us through all of the paperwork and the options there. And just in terms of the process, all of our investors in this particular hotel are people that we know, that know our track record and us personally and our experience.
Okay, cool. Right on. So are both these hotels the same brand, or are they different brands? Is there economies of scale with that, or not really?
So there's not economies of scale with the brand itself per se. It's not like, hey, I have multiple hotels and they're all under the Marriott brand, and so my toilet paper costs less. It's not necessarily that, because that's already happening at a corporate level.
Mm-hmm.
But there are economies of scale in our management of this. So we have general managers at the hotels. The hotels are down the road from each other. What that means is if one of our hotels is booked, people can be directed to the other hotel. Our general managers can cross-reference. They have different hotel systems because they're different brands, but the running of the hotel, those processes, there are economies of scale that way.
Okay, cool. No, that's good to know. I always wondered, like, when I've gone to a hotel and they sent me to another brand, I was like, I wonder if the same person owns this. They're just doing it that.
Yes, very likely, yes.
That's funny. Okay, cool. Well, there's tons of good information on that. Is there anything that you wanted to bring up about the hotel industry that I kind of forgot to ask, or anything like that?
Well, I guess the main thing is it does have more moving pieces, right?
Mm-hmm.
So it's more day to day.
Yeah.
It's more 24/7 than an apartment complex. But the difference is you also do get strong general management and your team in place, just like you get strong property management if that's what you're doing, or if you're managing it yourself. So that can scare people because they think, gosh, there's a lot of moving pieces. It is. And you do need to know what you're doing, but you can also surround yourself with a fantastic team.
So brings up another question is, did you guys just go out and find your own general manager to manage them? Or did you go to like a company and say, hey, we need a general manager to manage this? Because there is services like that, isn't there?
I'm sure that there are. I
Mhm.
think this is an example of when you get your foot in the door in any kind of industry and you start working in that industry, you become aware and you network and etc. So our general manager for our newest hotel was referred by the general manager at the original hotel that we purchased. So this was just, she knew that he was tired of his commute and highly recommended him, and he's fantastic. Fantastic. So we didn't have to go to a service. We would be able to replicate that over and over again because they all know each other. General managers, even though they're different brands, they know each other and they have long-standing relationships. We also get leads on hotel deals now because the general manager used to work with a couple of other owners, and when the owners want to sell, they call him up. And so it becomes almost like a snowball effect if you can just kind of get your foot in and start growing. And I'm sure, the same thing with multifamily.
Yeah, for sure. I think it's kind of like I love how you're talking about, you know, earlier you mentioned, you push the boundaries and then that boundary is like where you really start to learn the most, and then once you get comfortable, your guys' story is a perfect story of like getting comfortable. Okay, push the boundary to the next step. Okay, push the boundary to the next step. And that's when you really grow. And it gets so easy to be comfortable in everything you're doing, whether it's your job or your small investments or whatever. But if you have the desire to grow, you have to like push yourself to get to the next level. And then, yeah, it does. It definitely starts snowballing. I'm sure you've recognized that with your podcast, right? It's like you never knew how to do a podcast, but you did a couple things and you got better at it. And then the more people you interviewed, the more people wanted to be on your show and the more people listened. And it's like a snowball effect. And now it's just like running way easier than it was in the beginning, right?
Absolutely.
Yeah. So that's cool. That's just like push yourself. If it's uncomfortable, that uncomfortable spot because it's confusing or whatever, that is like the growth spot. That's like where you're gonna get the most out of moving to the next position in your life. So, well, that's cool. That's tons of good information. Let's kind of move to our next topic here. What is the best way you like to learn? Talking about learning about new industries and stuff. What's the best way you like to learn about? Is it books, podcasts, seminars, mentors? What's your preferred way?
I do prefer reading because
Mm-hmm.
I can read faster, or I guess I do enjoy the fact that podcasts can be listened to at a faster speed.
Mm-hmm.
And I will often listen definitely at a 1.5, sometimes at a 2, so that I can kind of get to the net. But I enjoy reading for sure. And that isn't necessarily just books. I also like reading blog posts. I like seeing what's happening. I do enjoy Reddit because I like seeing what people are posting about their challenges with real estate investing and what ideas they have around businesses. And I kind of enjoy seeing what people are saying there as well.
Okay, cool. Yeah. Reading's one thing that when you're a kid, or for me anyways, I hated reading. I like wasn't great at it because I didn't put a lot of time into it. And then as I got to be an adult, people kept telling me, oh, you should read this book and all this stuff. And I just hated it. But now in the last couple of years, I force myself, I read all the time and I really love reading, but I'm slow at it because haven't done it for, 35 years consistently. But I was watching a Bill Gates documentary last night and it says that he reads 150 pages an hour. And I was like, geez. And he reads sometimes several books a day. I was like, holy moly, no wonder he's where he's at. He's just consuming so much information. And he said his retention rate was like over 90% of every page that he reads. I'm like, that is unbelievable. Wish I could do that. But
Wow.
yeah, it's crazy. Okay, what about a favorite piece of technology or an app that you use that really helps you guys in your business?
I use an app called Todoist. And so it actually, I guess it does run on the mobile phone, but mostly I use it on the my desktop and laptop. It integrates into email. So what I find it to be super helpful for is to pop up emails, reminders, and I'm talking about Outlook specifically, reminders that somebody didn't get back to me on something. And then I also just really quick will jot down it's for me, it's nice to just get it out, and then I can assign it for a future time. So, oh, I need to do XYZ, and I can't just keep it in my head. There's too much going on here. So
Yeah.
I just quickly get it out on this app, again, Todoist.
Okay, cool. What about a mindset tip when you kind of get down, you're feeling confused or frustrated in something in your business? What's something you do to keep yourself on track?
So this is something I just started doing as a result of some coaching that Mike and I are going through. And it is basically review 5 positive things from the last day, so your previous day, and then what you're going to do to keep further progress in those 5 things. So I used to just write down things that I was grateful for, which I think that having gratitude and reflecting on where you are helps you stay grounded when bad things happen, because they are going to happen. So then you have to realize, okay, it's just not the end of the world, right?
Mhm.
There's all these good things happening in my life. But what I like about this particular exercise, it says, okay, that was great. How do I build on it? And that's really an interesting concept, to not just say, well, these 3 things I'm grateful for, done. It's more, okay, now I'm going to, and it could be simple thing like Mike and I took a walk last night, and that was just, it was really nice. The weather was beautiful. Took the dogs. I would like to do that 2 more times this week, as an example. So it can be those kinds of things, as well as achievements and just reflecting.
Awesome. Yeah, that's good. Because a lot of times we write it down, just like a goal or something we're grateful for, but then it kind of loses its luster. You know what I mean? Like you write it down and then you kind of forget about it and it goes away. But that's a good way to like continue to build on um, previous things. So good information. Okay. Well, Nicole, where can people find out more about you? Tell about your podcast and everything you're doing.
2 places. Probably the best is my website for the podcast, which is therichergeek.com. And another way is via LinkedIn. That is actually my preferred. Some people reach out to me on other social media sites, and I'm not as active there, but LinkedIn, I am absolutely checking and more engaged. So you can find me on LinkedIn.
Okay, cool. And great website, by the way. I was reading it earlier and it just flows nice. It looks good. I'm going to send it to my VA and say, I want my website to look like hers.
That's awesome. If your VA can do websites, maybe you should connect me with her, because I have more work to be done there.
Yeah, no, it looks good. Yeah, she does little things. I don't know how in depth she'll get, but I'm about to find out.
That's awesome.
So, well, Nicole, thanks for being here. There's lots of good information, and go listen to Nicole's podcast. Go check out her website. Learn from her. Obviously, she's doing great things. So, Nicole, thanks again. You have a great afternoon.
Thanks so much, Justin.
Bye.